So, good morning or good afternoon, depending where in the world you are, and welcome to today's Captive Review Virtual Symposium. I'm Lauren Ingram, the editor of Captive Review. So, we're running a series of these. So, welcome if this is your first one, or welcome back if you're joining us again. The topic for today is reinsurance, which for anyone in the captive industry is obviously very relevant and very important. So first, before we get into the topic, we're going to do some housekeeping. Our virtual symposiums are interactive, as you'll know if you've attended one before, and you have an opportunity to submit questions to our panelists. To do this, you just need to go to the website slido.com and enter the code CaptiveVirtual when prompted. There'll be a Q&A at the end, so make sure you put your questions in as the panel is going on, and then we'll be able to get to them at the end, and you'll be able to ask all or a certain person a question. So our panel today is on using reinsurance to reduce liabilities for future claims, and we have some great experts from both Europe and the US joining us. So we have today from Firma, we have Laurent Nihal, who is board member there, and he's going to be moderating our session. Our panelists are John Morey, who is the CEO of Builders Insurance Holdings Re, otherwise known as Builders Re. We have Teresa Stevenson, who is Vice President Insurance and Risk at RPAI Holdco Management. And we have Michael Schrögner, who is Chairman and General Counsel at Allied Professionals Insurance Company, RRG. So I'm just going to turn over to Laurent now, who's going to talk a little bit about Firma and what they're doing at the moment, and then he's going to dive straight into the panel. So thank you, Laurent.
Thank you, Lauren. So good morning, good afternoon, everyone. Just before starting, indeed, just as a bit of a background about Firma, for those who don't know. So as the name states, Firma means Federation of European Risk Management Association. So we are bringing together 21 national associations from 20 countries, and we represent a bit less than 5,000 risk and insurance managers in European countries and a bit beyond. We also have the Russian Risk Association, the Turkish Risk Association as a member. Personally, maybe a few words about myself. So I'm a board member, but I'm also in charge of what we call the Captive Initiative, which is aimed at promoting, of course, the captive industry's interest toward the authority. That's one of the main, with the purpose of Firma, is lobbying the authority. So over the last years, we have mainly dealt with the OECD around BEPS and the EIOPA, which is the European Supervisory Authority, around everything linked to proportionality in the way the regulatory regime should be applied to captives in European countries. So that's it for the background, just to be sure everybody understands what is Firma and what is my role within that federation. So the topic for today is around reinsurance and how it can be efficiently used by risk manager and captive owners to reduce liabilities and offset risk exposure. So it's quite a broad topic, I would say, and we should only be able to address a couple of key principles today, such as how to identify risk to be transferred and how to use reinsurance to optimize a captive strategy. And I would say also, if we look at the current environment, with the hardening insurance and reinsurance market, not even talking about just the COVID-19 outbreak and the crisis we are going through nowadays, I would say it's a very topical subject, and I would like to share with you as an introduction before leaving the floor to our panelists some results from the Firma Risk Manager Survey from 2020. So what we do is every 2 years we do a survey within the European countries, and it's around a bit less 800 risk managers, answering questions, and it allows us to have a an overall picture about the topic, the priorities, and what is relevant for the industry. And we have a couple of interesting figures before starting, which are linked to the main risk manager concerns in 2020. And out of the survey, we can see that 90% of the respondents have a major concern about limitation and exclusion for specific emerging risk, and 88% have a major concern about the changes in the market condition. And when they are asked how they intend to deal with these concerns, around 43%, so a bit less than half, raise the captive as a tool to help them to go through the hardening market and the underwriting restriction and shortage of capacity we are going through. So my first question, and I would say linked to that, I would say overview about what is a concern for risk managers would be the basic and primary question. And I would ask to John, what would you recommend, to help risk and insurance manager to identify efficiently the risk that should be transferred and the one that should be retained?
Good afternoon or good morning to everyone. Thank you very much, Laurent, for the question. If we continue down the path which you've already started of hard and soft markets, that would be my starting point for that discussion. If you're in a soft market environment, and let's face it, we've been in some very soft markets over the last 10 or so years, then why hold on to risk unnecessarily? If you can transfer it to someone else relatively cheaply, then I think that's probably the best thing to do with it. However, we have seen markets hardening over the last 18 months to 2 years, and I think obviously given COVID-19, I'm sure they will continue to harden, perhaps harden even more than we originally anticipated they would. Then, of course, it becomes interesting. At that point, you've got to decide, okay, what do I really not want on my portfolio at any cost? And then you have to transfer that. And then you decide then at that point how best you're going to deal with the risks you are going to keep on board. So identify basically your worst case scenario. What is the most I'm prepared to lose in any particular part of your portfolio, and then buy in excess of that. So I think we're moving into a hard market now, and I absolutely agree with you. I think this is the moment when you may want to start considering how you optimize use of your captive, because captives, I think, are very, very useful to you in a hard market environment. So that's a very generic sort of answer to your question. Yeah.
Yes, indeed. So you address more about the question about the transfer price to the market in either a soft or a hard market. But would you have some practical examples about that? I mean, in terms of concrete example in day-to-day business.
Okay, if we go into a little bit more detail, if you're in a soft market and you're transferring risk to the outside world, then why not look for a multi-year deal? If you do not think that your portfolio will evolve significantly over the next 3 to 5 years, you may want to go in for a multi-year deal which locks in the low rates, and that to a certain extent will give you some stability against market volatility. If you look at a market like I operate in, which is Luxembourg, there you are obliged to create equalization reserves. And the whole point of an equalization reserve is that it's a forward-looking reserve. Most of what we do with IBNRs and normal reserving strategy is a backward-looking phenomena. We're always looking at what has happened. The equalization reserve looks forward to what might happen, what's out there, what big pop can you not see right now, but what may well happen. And therefore, the environment forces you to build up an equalization reserve and forces you to build up funds to manage that big pot which might happen in the future. Obviously, if you're building up funds, then that enables you to weather market cycles much more effectively, because you've got money in the bank and you can take decisions about how much you want to charge yourself or not. You could also look at it from a sort of non-traditional route. That's something we've certainly tried over the years. We use a combination of traditional reinsurances and non-traditional reinsurances. So look at some sort of ART solutions to managing risk. These can often be very, very effective if they're dovetailed effectively with more traditional solutions. So there's 3 ideas straight away. Yeah.
Thank you, John. And it's so you talk about multi-years deal and how it could be useful to lock rates for a midterm period. And I would like to ask Michael, because Michael, I believe you have other very practical example, and especially around that fixed rate topic that you have been able to implement to also buffer changing market conditions. Can you tell us a few words about that?
I'd be happy to. Hello, everyone. I welcome to you all from all the craziness that's going on. Since we started this thing, my original picture had a goatee. I shaved that off, and now I've grown this. So it's been it's getting a little bit scraggly. Reinsurance is not simply a fungible single tool, but it's a toolbox of many different tools that you can apply to try to deal with 2 issues. One is your capital needs, and the other one is what risks you want to keep and what risks you don't. And those are not necessarily dependent on whether you view it as a good risk or a bad risk. The strength that comes with a captive normally is that they're far more knowledgeable in their small niche than most of the other companies that try to write in it. That doesn't mean, though, that they're necessarily large. So part of what you need to do is to look at, what are my capital needs? Do I have, for example, if our company has an AM Best rating. In order to have that, we have to have certain capital ratios. If you're small, you may be concerned about volatility. In other words, the risk ultimately will be a very good risk, but year to year it may go up and down depending if you get a shock claim or not. And so those are the situations that you need to look at in order to decide specifically what you want to do. Now, one thing you can do to address your capital needs working with reinsurers is simply basically get a loan from them, take a surplus note. Most of them are pretty willing to do it. We've never had any trouble putting those together, either for our own company or for companies that we broker reinsurance for, if that's the easiest solution to create the ratios that you need from surplus to the amount of premium that you're allowed to write. No regulator will let you write above 3 to 1, and most rating agencies get very cranky if you start going above 1 to 1, and prefer somewhere between 0.5 to 1 to 1 to 1. Another way of accounting for getting your ratios correctly is simply to take a piece of your premium and give it to the reinsurers on a percentage basis in what's known as quota share reinsurance. That takes it off your books. It lowers the amount of surplus you need in the company in order to keep your ratios complete. And they basically follow the fortunes. If you do a quota share reinsurance for, let's say, 25%, then for that, they pay 25% of all LAE and all ULAE, and however you work it out, and of course all of the claims. And this can be on a sliding scale. You can have an agreement where the percentage of the quota share changes every month depending on how much capital you have coming into the company. So that very much allows you to manage and fine-tune your capital ratios and maximize what you need to do. One thing to pay attention to, if you don't do quota share reinsurance, particularly because of COVID, is that the other kind of reinsurance that is typically done is what's called excess of loss. And what this means is, let's say you have $1 million policy, perhaps a small captive retains the first 100,000 of every claim, and then they purchase a reinsurance treaty for 900,000 in excess of the remaining 100,000 to get you up to the $1 million, or it could be an attachment point, can be anything that you negotiate. And of course, the percentage for your premiums that you give over can negotiate. You might say, okay, I'm going to have a retention of 100,000, and I'm going to give you, 35% of my premiums. In this pandemic era, where insurance companies can potentially be swamped, one of the things to pay very close attention to is that those treaties are not unlimited. They have a finite amount of cover that you get for that. It sometimes ranges between 200% and 500% of what you have paid in reinsurance premiums. So if you paid, let's say $1 million in reinsurance premiums, you're getting somewhere between 2 million and 5 million before the treaty cuts out. There's a very important provision that normally doesn't, get much interest in a reinsurance treaty, but given if you're now, for example, insuring nursing homes in the COVID era, you'll be looking at this provision a lot, which has to do with whether or not, if you exhaust your limits, do you get a reinstatement? Some companies give you a free reinstatement. Some people allow you to buy one reinstatement for the full additional premium. And this would again allow you to get another set of limits, but it's very important to look at what your absolute cover is, and it's something you can negotiate. So you'll be offered a lower one. A lot of times you negotiate for a higher one. You negotiate over reinstatements. You can have different, within your treaty, your reinsurance treaty, you can create different subparts that cover different things with different limits. You can have one part for property. You can have one part for liability. And if you have a couple of, one-off kind of situations, for example, the state of Virginia requires higher limits statutorily than anywhere else in the country. Well, you may not want to retain that, but you don't really want to pay for additional limits when only 2% of all your premium is there. So you can do what's known as a facultative, where you you just basically agree to what the rate on line is for that additional limit and just give that over to the reinsurer directly. They just get all of that. And the treaty only as to those things covers just those risks, and you only get charged every time you add a new risk. Two other concepts. One of them is you can negotiate either a flat rate or a swing rate on your excess of loss treaties. A flat rate would be, we're going to give you 30% a year and you're going to pay everything above $200,000. The swing rate would be, we're going to pay 10%, but the rate can swing up as high as, let's say, 40, depending on what your losses are. And essentially what happens is your losses, as every loss comes in, it basically pays into a deductible, and then you pay an overage of 5% so you get up to the higher rate. If you're a new captive, or you're a captive that's in an area you don't think people really understand how low the risk is, and we've done this repeatedly, we say, well, if we're going to put our money where our mouth is, let's do a swing rated treaty. And from that swing rated treaty, if you're right, you do pretty well. If you're not, then it can be expensive. The biggest downside to swing rated treaties are the fact that the rating agencies don't like them, and they tend to, when they figure out what they think your financial strength is, they tend to max out every treaty and say, we're going to assume that you pay the max rate on everything, and that can be a drag on your ability to maintain an A rating. And finally, one other option in your toolbox are binders. If all else fails in looking at everything else, you oftentimes can enter into a deal with your reinsurer where some of the risks just get put on their paper. They're good risks, but they may be too volatile for a small captive. But with a big reinsurer, they can wait for them to for the up and down to even out. So those are the tools in your toolbox that you can use to manage your capital and decide what risks you want to retain versus what you want to put out to a third party.
Thank you, Michael. That was lots of details, but interesting. So if I try to summarize quickly, and correct me if I'm wrong, but your opinion is more around, quota share is really a capital management tool, right. And everything around excess and the various alternatives you have described are really where there would be a focus about transferring risk, and then it's about how to optimize that risk transfer. Huh?
That's exactly right. The surplus notes and the quota share treaties are capital management tools, and the rest of them are primarily risk management tools, although it does affect the capital that you need.
Very good. If I can now turn to Theresa. I'm sorry, Theresa, I don't know what happened to ladies first, but that's life for today. So maybe can I ask you the same question, because I know you have also implemented specific reinsurance solution to support your risk transfer strategy and risk financing strategy. So we would be interested in hearing a bit of details from you.
Yeah, just as a little background, so first of all, I work for a publicly traded REIT. So as a retail landlord, we have the ability to bill back as part of our common area maintenance, our insurance costs. So it puts us in a unique position that we can recoup a lot of our insurance expenses. So really, when we're kind of looking at in how we utilize our captive is taking a look and first of all having the control that we need for management of our properties and our losses, but also taking a look at what those retention levels should be. So we went ahead and worked with our broker in doing that financial risk analysis as Mike spoke about, and taking a look at what our exposures were versus, and then laying that over the programs that were available and taking a look at what would be the best advantage for our PAI with regards to our retentions. We looked at all of our lines of coverage, but being mainly clerical and some property management from a work comp perspective, it just didn't make sense for us. So really where we concentrated on was our general liability and our property. From a liability standpoint, we're really comfortable with what our exposures are each year, kind of consistent with regards to the number and severities that we have. And so with that, we were very comfortable with taking on a retention of $100,000 for every claim. Now, we don't have a max on that, so our reinsurance agreement sits above $100,000 at each and every loss. On the property line, we went ahead and went from $100,000, $150,000 each loss, excuse me, to $250,000. And with being able to do that, we were able to kind of handle the frequency type claims. And so really our carrier is sitting above on something that is more from a severity standpoint. But also what it allowed us to do is take a look at certain needs that we had from a lender perspective for the National Flood Insurance Program, where most carriers won't drop down and pick that up. We were able to go ahead and take the $250,000, which we would normally buy through the NFIP program, the National Flood Insurance Program, and take that directly within our captive, and able to show through our reinsurance agreement that our deductible is $10,000. So all of our agreements were able to show and meet our requirements at $10,000, but yet the captive takes the next $240,000, and the reinsurance then sits on top of that, up until the maximum limits and the tower that we buy above that. So it's very clean, and the carriers really like it because it shows us from a marketing standpoint being able to show that we have a control over our risk, but also that we have, quote unquote, skin in the game, right? So it makes us very attractive to the other markets that are out there. And the way that we've set that up is 2 separate reinsurance agreements, one for our property lines and one with our liability lines, even though the same carrier covers both of those. It just gives us a lot of flexibility with regards to marketing our account and controlling our collateral that we have to provide for each one.
Thank you. So if I quickly try to summarize, what we have said so far, I would say we have mainly talked about, let's call it the financial aspect of optimizing risk transfer and risk financing strategies with reinsurance. We have, talked about quota share, excess for risk transfer. We have talked about the multi-year deals. We have talked about adjusting retention, Teresa, as you just explained, which are all, of course, well-known tools to optimize a risk financing strategy, but also to buffer market condition. But basically, we are around, the usual basic principles about, managing your own risk profiles, focusing on total cost of risk, and managing retention to buffer the changes in the market condition. If I may, maybe we could switch, to there are also, reinsurance could also be a tool to operationally, if I may say, optimize the way you use your captive, because we all know, of course, there is always a financial angle in retail, transferring risk and optimizing the cost of that. But there is also some usage of reinsurance that are helpful to optimize the operation. You know, the captive very often can be a tool that help to have a more efficient insurance structure because you are a multinational corporation, or because it can support your business in different aspects. So Theresa, now to stick to the ladies first principle, I would like to ask you a few details about some solution you are implemented with that regard. So meaning, you know, to support operationally the use of your captive, you know, in your overall risk financing strategy.
Sorry, it's on mute. So one of the things as a retail landlord, the lease agreements that we carry require us to carry unrealistically low deductibles. And we don't have as much control over those leases, because as we acquire assets, we also require those lease agreements, and it takes us a while to kind of run through those and get those transferred onto our forms. So there's a lot of volatility within the insurance requirements on the landlord from lease to lease. So for us on a $3.3 billion portfolio to carry a $10,000 to $25,000 deductible is extremely cost prohibitive. So we are able to use the reinsurance agreements from our carriers to be able to show that we have that $10,000 deductible, but then through the use of the captive, take on the next $240,000 and have control then from a pricing standpoint, and be able to use that additional premiums to fund the captive. It gives us a lot more ability to meet those requirements without having to take on the additional cost. And as I mentioned before, from a marketing perspective, the carriers like the fact that we have a captive, that they don't see as many in our sector. So they like the fact that we have it. It speaks to the controls that we have been able to put in place. And they also like the fact that, you know, we are vested in the losses, and they feel that we're taking on more control because we're taking on that first 250 of every claim. So it gives us a lot of flexibility in that area. From the liability standpoint, again, it's so much not obviously a deductible, but basically just the administrative costs, going ahead and taking a look at the cost of retaining those and being able to retain those premiums dollars, obviously is more cost effective than having to buy it at $1.
Thank you. Michael, can I ask you to give us a bit of details about another example in that area, let's call it, of operational optimization, of, you know, using reinsurance to optimize your captive management process?
Well, there's an interesting example, I think, that is actually become particularly pertinent with what's been going on with COVID, which is one of the ways that you want to sort of optimize your risk profile is to look at situations where your reinsurance won't cover a particular type of claim. So, for example, if you have a lot of claims that come in all of a sudden that you hadn't anticipated, that are from a single cause, that are below your retention limits. For example, if you have let's say 100,000 attachment point or 300,000 attachment point, and then you're the one that was insuring fen-phen, and you get $10,000, $30,000 claims, you're going to get swamped. And one of the ways of dealing with this for the last 10 years has been what are called systemic treaties, where you put together a treaty that says if there's a new thing that comes along that has a common denominator, which in this case, of course, what I'm talking about is COVID, then you pay, then after a certain attachment point, $1 million or $5 million or whatever it is, then that treaty picks up the risk beyond that. And that up till now, that has been a relatively inexpensive cover. You can buy, you know, $10 million, $15, $20 million worth of coverage for pretty much 1% online of what your total premiums are. And so this covers below your attachment point, but a lot of claims. This, we're working on our July 1 renewals right now, and the things have gotten particularly wild on the renewing the systemic treaties, because many of the carriers are pushing for exclusions for pandemics or specific COVID exclusions, or they won't renew the treaties. And so you might have situations where you've been optimizing your captive up till now with a systemic treaty, but after a certain date, July 1, any claims that come in after that, you will no longer be able to get that covered. But doing systemic treaties is one specific example, but I do think that's very much going to change the ability to get those kinds of things over time.
Thank you. Indeed, interesting, you know, these systemic treaties. That's something I would like to explore a bit more. John, maybe if I can ask you the same question in let's call it once again the operational area of our business. If you have some practical or concrete example to share with the audience.
Yes, of course. This is, I agree with my colleagues here, that this is very much an evolutionary process. As the business develops, then you have to develop with it, and as the background develops, you have to develop with that as well. Starting at the very simplest level, we have gradually increased our retention over the years. We started at $250,000. We're now at $1 million as our confidence grew. We try and concentrate our activity in the working layers, so where we believe that risk management makes the most difference at the first dollar level, and we really believe in good risk management. As our confidence built up and as our equalization reserve built up, we increased the retention. We retained fourfold, so we're now at $1 million. On top of that, we had a look at the aggregate as well. We felt that the aggregate was way too far out. We were at something like in excess of 1,000 years. Our board did not want to live at those sorts of odds. So we brought the aggregate down to a much more manageable level, about sort of once in the sort of 150 odd years or something like that. That obviously is quite expensive to do on a big US casualty portfolio. So we came up with a scheme with our reinsurers that we pay a reasonably large premium up front, but we get most of that premium back for good behavior if we do not use the cover. So we have a sizable profit commission. Obviously, it's a little bit expensive in the early days, but it provides a peace of mind. But once you start to get that profit commission back, and of course we haven't used the cover, then it sort of has a revolving effect, and it's never too expensive at any one moment in time. I think aggregate's very important. We're always looking at our aggregate. We're always looking at the sort of the worst case point, and making sure that we never get anything beyond that. We have recently restructured one of our major surety covers, and we've taken on a lot more risk with that. And again, we've done that by a non-traditional route. We know that portfolio over time runs at around 60% loss ratio. So we run it basically at least 60% loss ratio. If we are having a good year, then we will put surplus funds onto one side. And if we're having a poorer year, then we will take funds out again with a view to maintaining that 60% loss ratio. Of course, we have traditional insurance in excess of that, just in case something goes horribly wrong and we get that unexpected pop that comes from nowhere. So it's a combination of traditional insurance and non-traditional insurance. And we also purchased about 10 years ago, and we've been doing it ever since, a whole account excess of loss, which really protects the bottom line. It's a sort of stop loss on the net position, and it allows us to bring an element of stability into what we declare back to the group. We are a profit center, although we have captive elements as well. Therefore, we don't want to provide the group with unnecessary volatility in terms of our result. So we bought this whole account excess of loss to make sure that we don't get too far away from the target which we've set ourselves. And that again is providing that sort of peace of mind at a board level that we aren't going to come up with any nasty surprises at the end of the year. There's a few examples on our front.
Thank you very much. If I may, I know I'm not supposed to do that as a moderator, but I would like to share with you also a very practical example about how we use reinsurance to optimize the way our captive is structured and how the risks are covered within our entities. So of course we are a multinational organization, so we have more or less 60 countries in our programs. And what we have done is that we use the captive, for instance, as what I would call a central underwriting unit, and then we go into the reinsurance market and we buy several different covers. Let's say, for instance, of course, protection. Let's take the property program, for instance. Of course, we buy PDBI cover, but then we go to other reinsurance market where we can buy, for instance, terrorism or political violence. We go to another reinsurance market where we buy cyber cover, and we can also go to another reinsurance market for buying natural catastrophes cover. So what we have is we have a bunch of different treaties or FAC country covers with different reinsurance market, and we use a captive as a filter to deliver to our entities in their countries one single insurance product. So they have one insurance policy in whatever, Brazil, the US, European countries, wherever, with the full set of covers available in one single insurance policy. That's a way of optimizing the use of reinsurance, because you can really access the most relevant markets for the product you need. It's also because sometimes you can have, if you look about cyber, it's really specific if you have to fine tune it and really adjust it to your activities. And it also allows the mess of having multiple fronting arrangement in the countries just to ensure that the cover can flow to your entity in the country. What it requires is a very strong, flexible fronting partner, of course, because you need someone being able to translate different wordings and to accept that your captive is reinsured at maybe a different attachment point with different capacities from different reinsurance markets. I just wanted to share that quickly because in the way reinsurance can be used professionally, optimize your risk financing strategy. That's something that we do. Of course, there is also a financial incentive because we like to believe that we access also the best rate by accessing the best markets for certain risk. But basically, it's mainly for us a tool to ensure that our coverage locally is as complete as possible and as simple as possible for our entities. So sorry for jumping into your panelist discussion, but I thought it could be interesting maybe for the audience. I would like now, as what I would call the introduction to the conclusion, I would like to raise the question around, the hardening market, and especially the potential impact of the COVID-19 crisis, because that's something, of course, that is going to evolve. So nobody really knows what is going to happen. You can read here and there what will be the impact on the insurance industry. I know in the US there are some discussion about, should BI covers be retroactively granted to companies. But I'm still wondering how you can do that. But that's an interesting discussion that we are following up here in Europe. But my question, as I said, to introduce the conclusion, would be about getting your insight and your feeling about what evolution you see and what will be the impact on the insurance and the reinsurance market, and how captive owners and risk managers will have to look at shifting exposure, transferring risk in that kind of environment. And do you think that it will accelerate the hardening of the market, and then basically that it will push us all to focus even more on everything we have just said before around the different solutions to transfer risk, manage capital, operationally optimize our strategies. So just as a generic or overall conclusion, getting your insights, as I said, nobody really knows what is going to happen, but we have the chance to have smart and knowledgeable people in the panel. So it would be interesting to hear a bit what you think. Teresa, maybe we can start with you.
So our renewal is coming up in December. We were fortunate enough at our last renewal, we were coming off a 3-year rate guarantee. So we were able to negotiate an increase for this coming year, but at a very reasonable rate. So to kind of ward off some of that volatility. What we're seeing here and what I'm hearing is that here in the US, kind of what we were seeing is the trending and the hardening of the market, and the percentage increases on the property lines seem to be pretty stable. And I think the primary liability lines, I think where we're seeing a lot of volatility is in the excess liability lines. So I think that opens up other opportunities from a captive perspective of where we've been traditionally taking it on the primary retention levels, at what we want to do at more of the excess levels. So I think it's really kind of a wait and see for us in our market. For me, and being in retail, it's kind of utilizing the captive to keep some of the stability of the premiums that we charge back to our tenants, because obviously this is a difficult time for most retailers. So having some stability within our premiums is going to be paramount for us.
Thank you. Now maybe John, you are just next, on my screen, so maybe I can ask you the same question.
Sure. Yeah. Well, the market was definitely hardening, and we were somewhat relieved to see that after so many years of a soft market. And I think COVID-19 will certainly reinforce that. I think there'll be two probably reactions out there. I think there'll be certain markets will try and exclude it going forward, which means captives may well have to think about taking it on. Other markets will possibly see it as an opportunity, but we'll have to pay for it. It'll be priced, and there'll be strict sublimits and all that kind of stuff. But you may actually be able to have it. It certainly won't be granted thrown in for free. I think we can probably, as we speak, hear the lawyers rewriting everyone's business interruption policies. There's no doubt about that. Business interruption is never going to be quite the same again. I think going forward. So I think we'll see variety. I think ultimately the market will be forced to find a solution to it, because it has to. And it will be a combination of using your captive and then buying excess coverage beyond which you no longer feel comfortable. I think it will create some tensions in markets. I was reading an article which a colleague passed to me about what's happening in France at the moment. The French market had held pretty well firm on wanting to avoid the COVID-19 claims, but I see that two bank insurance companies, Crédit Mutuel and Crédit Agricole, have decided that they're going to break ranks with the rest of the market, and they are going to start paying these claims. So what's the rest of the market going to do? It remains to be seen what they will do. They'll almost certainly be forced to follow to some extent. But it'd be interesting to see what their reinsurers say about that. But there we go. There has been, within a market which had held firm up until relatively recently, there are showing signs now of people breaking ranks and going their own way. So I think we're in for a lot of volatility. I think we're in for a bumpy ride. But ultimately, we'll have to find a solution, and it will be a combination of the market reacting positively to what's out there, pricing it in properly, and using the captives effectively as well.
Thank you, John. And last but not least, maybe Michael, if you have some comments around that topic.
Yeah, sure. The number one thing that we're seeing right now because of COVID in the insurance marketplace is just raw fear. People aren't sure what's going on. There's a great deal, separate and distinct from this trend we already saw of markets hardening. There are a lot of people out there that are simply afraid. Probably the best example of this is on one of the July 1 renewals we were working on, we had we received a 5-page questionnaire that, for example, one of the questions is, will any of this company's insureds or third-party service providers go bankrupt? It's like, I don't know. Or could this potentially substantially affect the operations? There are 5 pages of this. We just sent the questionnaire back and said no, thank you. But it was a good indication of just how much fear there is out there. The effect on claims is going to be interesting. For example, our company, we insure primarily alternative healthcare providers, about 90% of the acupuncturists, about 2/3 of the massage therapists, about 40% of the chiropractic doctors, and a lot of other providers. About 80% of the people we're insuring right now are probably not practicing. As a result, you would expect claims to drop off. And in fact, in the month of March, we had our net number of open claims drop almost 10%. I've never seen that before. I think April will even be stronger with that. On the other hand, there's going to be some drop off in premiums. Some of the people are not going to keep their insurance in place because they're not operating. Some of the claims are because there's really no access to the courthouses. So I think you will eventually see some of those, the pent-up demand, come back up. We've kept a keen eye on this business interruption issue. I just finished 2 years as chairman of the National Risk Retention Association, and we've been watching this from a national legal perspective. Our best take is that there's going to be a lot of class action litigation to try to make these business interruption policies retroactively cover things, even if they're excluded. There is some legislation in New Jersey, as an example, where they want to retroactively basically require every policy that's been issued to cover business interruption retroactively. Our best take is that probably violates the United States Constitution. It has a clause about not a contracts clause where the government can't rewrite contracts, and a takings clause where the government just can't come in and take your stuff without just compensation. You're going to see a lot more COVID exclusions. We're already seeing them proposed. I mentioned the systemic policies I think are going to be more expensive to get. And you're going to see a lot of questionnaires from everything from the National Association of Insurance Commissioners to your regulators to your auditors, everybody on the planet, rating agencies. Every day in the inbox there's a new questionnaire.
Yeah, and just to confirm, we have renewed our dinner program, and the inception date is April, so it cannot be a worst date for renewal for your dinner program this year. So the last month of the negotiation was, perfectly in the middle of the crisis, and we have had crazy discussion with underwriters about, a CV-19 exclusion, which was so badly written that it could have excluded everything coming. So we have been able to push that back. But I believe you're right. There was, as always in a crisis, you have a lot of nervousness and a stupid reaction because everybody wants to be quick. You have these stories about, questionnaires, which is an easy way for underwriters to not make decision. Okay, let's ask, further questions. Who knows? Maybe at a point we will have one question that will not be answered, and we can decline. Whatever. So it's. But thank you. I mean, I want to, because I see the time is running. So before going to the Q&A, I'm sure Lauren will do the same, but I wanted to personally thank you, the three of you, for speaking during that session and providing us all with some very interesting practical examples about how you personally use reinsurance to optimize your overall risk financing strategy, and share your thought and insight about the market and its potential, let's say, evolution. So thank you all, and maybe I will give the floor to Lauren to introduce the Q&A, or should I do that by myself? I don't remember what I said.
That's okay. I can introduce the Q&A. Thank you so much. So we've got some questions up here, and we've got quite a few questions here. So I do apologize to anyone if we don't get to your question. So We've got one here from Andrew Clark. So thank you so much, Andrew. What is the panel's experience of cross-class multiple year protections? Any recommendations in terms of structures? So I might go to Teresa first. Is there anything you would like to comment on this for Andrew, and any advice you can give?
So we we actually look at each one line individually and set up our reinsurance agreements on each individual line. So our reinsurance and our rate guarantees are kind of done on a per line basis. I have not done across. So I don't really have any experience in that area. We used to do a single reinsurance treaty across multiple lines, but I felt it gave me less flexibility. There is definite advantages where if you have a poor year in one line versus the other, it can help off, but maybe some of the other panelists can kind of speak to experiences they've had in that.
I can offer one thought, which is whether it's cross-class or single class, if you're going to do a multiple year treaty, the thing you have to look at is if it's going to be a swing rated treaty, you have to look at whether or not the swing accumulates. What I mean by this is if you have, let's say, $1 million in premium and you have a treaty that says, this is an actual example of something I saw where it was a swing rated treaty, 100,000, 10% minimum, 70% maximum, but it was a 3-year treaty and the swing accumulated. So what that meant was over a 3-year period, you would have to have losses 210% of the total amount that you took in order to receive any cover, which would have buried that particular captive, and we renegotiated that. But if you're going to do a multiple year treaty, you either have to fix the swing or you should go with a flat treaty over that time period. I also completely agree with Teresa that the only real reason to do a cross-class treaty is if you want to be able to have the ability of one of the classes to buffer sort of the claims experience of the other. But typically, I find negotiating each one of them separately works out better.
Yeah, if I may just add, for us, we are a steel and mining company, and our problem, we don't do cross-class protection just because our risk profile doesn't match that, because for us, property and business interruption is so big compared to other risk that we have to focus on that. So what we do is that we focus on the let's say kind of covering the aggregate retention at the captive level, because we take exposure on each and every loss. But it really depends. You need a risk profile that allows you to have something that makes sense, because if you have a 50 or 100 million retention on one risk and a 500,000 on another, well, it doesn't make sense to have a cross-class business. I would agree with Michael that very often working on an individual line basis is more efficient. And also now multiple year, frankly speaking, if I look at the market, I don't know so many carriers that will still go for multi-year protection, and especially in the crisis time we are in now. But that was just an additional comment.
If I could just perhaps add a comment as well, because I'll perhaps differ a little bit from my co-panelists. I've actually found the cross-class multiple year protections quite useful, but in combination with more traditional coverages on individual classes of business. And we're using cross-class multiple year protections on the net position. So after all the other covers have come in if necessary. I agree that you have size differences in terms of the lines that you've got, but you can broadly usually put things into a basket if it's at a net position. And that provides very useful stability on the bottom line result. If something goes wrong in one particular column, you have a cover of last resort that will put that right. So I have actually found that quite useful to have that in place over the years, but not for everything. It's the final cover that comes in, and it works on an aggregate basis, like you've just said, Laurent, against everything. Yeah.
Thank you, John. I see we have another question, which is, oh, it disappeared. Oh, no, it's still there. Do you have experience with third country reinsurance cession from Europe to offshore reinsurer? That's a strange question because I can say yes, and I'm answering your question, but I'm not sure about what you mean by that. So yes, we have experience in ceding risk to third country reinsurance companies. Yes. That one it could be interesting. Reinsurers face claims from COVID, plus a reduction in asset base due to investment losses. Which of these do you think is impacting future activity most? Jesus, the investments should be quite significant, but maybe they will recover. And the claim from COVID, I have no clue. My dear panelists, do you have any feeling about what is going to impact? Michael, you were talking about capital management through reinsurance. What do you believe will be the most impacting of these two?
CAT claims had already begun to reduce the amount of capital that was in the insurance markets, and I think that was what was beginning to contribute to a hardening market, simply because there was fewer capital assets chasing, insurance opportunities. It is very likely that COVID will be the single largest insurance event in world history, but at this point, none of us know really what the impact's going to be. We know that some work comp carriers are going to get whacked. We know that some nursing home companies are going to take a hit. And beyond that, we really don't know. So I think the single biggest driver really won't be for a while capital. It's going to be fear, and fear of the unknown. And I think reflexively, everybody's going to want to raise their rates just because they don't know what's going on.
I fully agree with Michael on that. It's way too early to have any clear picture as to how it's going to affect us, but I'm sure, absolutely convinced it will affect us. I think the investment losses, while they're painful quite now, they will slowly recover. We were discussing recently at an investment committee meeting whether we have a V-shaped crisis or a U-shaped crisis or an L-shaped crisis. Whether we go down and bounce back up relatively quickly, whether we go down, we run along the bottom for a while, then go back up, or whether we go back along the bottom and stay on the bottom for quite a while. I think the good money is on a U-shaped recovery, so we'll bump along the bottom for a while, but we will recover. I don't think this is the end of civilization. I think we definitely will recover. So I ultimately think the money will come back on investment front. But I think, and I agree with Michael, that insurance and reinsurance has changed forever by this, that they are just going to have to rethink the whole game.
Yeah. But one risk also is the downgrading of investment. And that's something we have not seen so far. Insurance companies, at least in Europe, have been pushed over the last 10 years to massively invest in sovereign debt, because it was interesting for the states to have a big pocket funding the debt from all the countries, and in the regulation it's something that is helping their solvency ratio. But if we start to see countries downgraded, which could be the case, I mean, think about Italy. That was it was already in a not so good, I would say, situation in terms of its debt. We are still paying, the last crisis from 2008 and 9. So you could have countries being downgraded, and that could have a huge impact about the solvency ratio of insurance companies. And now, thinking about what you have said, I would say, to answer your question, from my perspective, that's a big risk on the investment losses. Not really the loss of investment, but the impact it will have on the solvency ratio of insurance and reinsurance companies. That could have a huge impact on their, let's say, underwriting appetite. Good. I see it's Lauren, maybe you can help us. I see it's already, we are close to the end. So should we take another set of questions, or should you conclude?
So that's all the questions we have. There hasn't been any more come in, but I can, I just want to thank you all for coming on. It's been a really fascinating panel, and I think everyone has gotten a lot out of it. We really appreciate your time, and I want to thank everyone for tuning in. Just a reminder for everyone that we do have our Captive European Summit, which has launched, which is going to be from 9 a.m. to 1 p.m. on Wednesday, the 17th of June. So it's aimed at European captive owners. And if you're interested in that, there is a website launched and you can get in touch with us. And just a reminder that next Tuesday we have our next symposium, which is on insurance runoff. So if you're interested in that, please make sure to tune in. But once again, thank you to our wonderful panel and for giving all of your expertise, and hope everyone has a great day.
Thanks all.
Thank you all. Bye.